Hi, everyone. It's Joe Veneri, the host of Fit Insider, the show where I talk with the entrepreneurs, executives, and investors who are redefining the business of fitness and wellness. Today, I'm joined by Brett Thomas. Brett is the co-founder and managing partner of CAVU Venture Partners, a leading venture capital firm investing in better-for-you food and beverage brands, as well as companies across health and wellness. In this episode, we discuss the evolving definition of health and how it's broadening the firm's thesis. We explore the art, science, and luck behind investments in Beyond Meat, Vital Proteins, Hims, and Thrive Market. And Brett talks about CAVU's role in a new $225 million SPAC targeting the health and wellness space. A quick reminder before we get into today's show. Every Tuesday, we send a weekly newsletter filled with insights and analysis on the business of fitness and wellness. Join other decision makers and industry operators by subscribing at insider.fit.co. Let's get into it. Hi, Brett. Welcome to Fit Insider. Thanks for joining us.
Thanks for having me, Joe. Appreciate it.
Yeah, likewise. I'm super grateful to have the time today and chat with you. And I think just to kick things off, can you introduce yourself? Tell us a little bit about CAVU Venture Partners.
Yeah, absolutely. So CAVU Venture Partners was founded in 2015. My background briefly was I came from the hedge fund space. And what I realized was that early on in my life, my grandfather always gave me a piece of advice that was very meaningful. And his advice was follow your passion in anything you do. And if you get to 30 years of age and you're not doing your passion every day, meaning the job that you're currently working in isn't your passion, then you should leave and go find that passion and follow it. Because if you get to be 40 or 45 years old, it's very hard with the financial responsibilities you probably have and children to go out and take that risk. So I literally took that advice to heart. I found myself in my 20s, living in New York City, working at a hedge fund, and thought that could be a great career path from a monetary standpoint, but it wasn't what I love to do. I think, getting up every day and there's a scorecard, you either make money or lose money, and there's nothing really tangible you're building. And so I decided to go pursue my passion. I gave my 2-week notice, and I actually messed up. I forgot about the 2-week notice part. So I actually left a week after my 30th birthday, but close enough. And I went out and left this is 2009. And my passion was consumer brands. I spent many years as a child with my grandfather, who was very impactful in my life, going to Kmart's and Targets and going up and down in aisles, looking at packages, looking at new brands, and understanding why every brand had a reason for existing, right? And every good invention came from some problem or someone's problem, right? And so with that kind of momentum, I started to really take a look at kind of private consumer companies, mostly in food and beverage at the time. And I think the biggest aha moment for me came in 2010 when I became a parent for the first time. And listen, I grew up in the Midwest on a steady diet of chips and soda and mac and cheese. And seeing the shift from becoming a parent to what my parents were feeding us in terms of reading the label, scrutinizing what they gave us to eat. It didn't exist back then. And how we found ourselves parenting in 2010 with our firstborn was really my aha moment of there is a huge secular shift coming here where, what you put in your body, the food and nutrition, has a meaningful effect on your wellness, on your health, on whether or not you get disease or not. And so that was my moment where I went full on into kind of better for you, health and wellness, started primarily with food and beverage. I was out there meeting the who's who in kind of consumer CPG. And obviously, if a deal came to me early on, Joe, the first thing that would pop up in my head is, why am I so lucky to see this deal, right? Especially being a new entrant into a category. And so I wanted to go surround myself with the difference makers. I want to seek out those that have had previous successes to learn from them. And obviously, they probably get the best deals, right? There's that virtuous cycle that happens where, once people find success, there's almost a badge of honor in terms of other brands wanting to be affiliated with that success. And so I met my business partner, Rohan Oza. I was a huge fan of the marketing work he did at Vitamin Water, right? He was the third partner there, and he was the CMO. And I thought it was fascinating what he did by putting 50 Cent, with the equity deal he did and activating that brand and putting, Jennifer Aniston in Smart Water and the activation that happened there. And so we became fast friends. We started investing together. And then in 2015, we started to co-found CAVU Venture Partners. CAVU stands for Ceiling and Visibility Unlimited. It's a pilot's term. It's the perfect flying conditions. And for us, the way we think about that is that's our aspirational viewpoint on clearing the skies for our brands to make it a little bit smoother, right, in their flight. And as you know, as entrepreneurs, it is a roller coaster. They're high highs and very low lows. And trying to make that journey a little bit easier is kind of was our goal with naming it CAVU. We looked at the landscape as we were forming CAVU and trying to create a firm that could make the news, not just report it. And what we found is a lot of firms that are out there that have had tons of success and have been doing it one way for a very long period of time. And there's nothing against that. But we really saw an opportunity in the marketplace to provide entrepreneurs with more kind of brand knowledge and expertise from people who actually have built brands before. And, with Rohan and our whole DNA based on trying to be founder friendly and helping make the difference, adding significant value to these businesses if we can to affect their trajectory. The experiences, whether it be at Vitamin Water or at Vita Coco, which he was involved with, or Buy or Pop Chips, all the successes and all the failures, that is institutional knowledge that's valuable. And if we could pass that on to entrepreneurs and founders and help them avoid some landmines on their journey, that was kind of the goal. And so when we founded CAVU in 2015, the main DNA of our firm is a value add component. How can we add value to all these brands that we partner with? And so with that premise, we launched in late 15. Our first fund was 155 million. We were primarily focused on food and beverage. Again, I think health and wellness all starts with what you put in your body. So that was our target focus. And that's kind of how it started.
Yeah, it's an incredible story. And I think, so much of what you touched on there, I definitely want to get into and kind of unpack. But even at the highest level, thinking about, the firm and doing some research for this, how it's characterized, democratizing healthy living, focus on backing, better for you food and beverage companies, and now evolving into just like this broad definition of health and wellness. You talked a little bit about the origin story of how you landed on this thesis, but how do you even define it in terms of knowing where the guide rails are, or are there no guide rails as like this term continues to expand so vastly?
That is a great question. And I think if you asked me, 6 years ago when we were, in 2015, I would have said health and wellness was primarily, food and nutrition. And you fast forward to today, and we're looking at human performance and personal care and beauty and digital connected fitness and mental health. And so I think obviously you have to evolve or you die. And I think given that we started off with founding roots of being about democratizing healthy living for all humans, even though it started with food, right? Because our mission when we started was not everyone can afford healthy food. Not everyone's educated on what you should eat and not eat, right? You think about it, there's a lot of misinformation out there, right? I mean, we've been positioned for years in terms of thinking that fats are bad for you, right? And you should go low fat, low fat, low fat. But then all of a sudden there's information that actually there is such thing as good fats and that you should incorporate those in your diet. So that previous kind of food pyramid, right, is actually inverted. And so again, that was funny enough, why we invested in our first investment actually was a brand called Thrive Market. And Thrive, I think, really hit with what our DNA was and what they were doing, because they were doing it from an authentic standpoint, right? Where they wanted to help make, food accessible at a lower price point and more affordable for all people, right? Not just, the upper class, so to speak. And that's a real issue that's meaningful to us. Again, I think it's an evolution, not a revolution. Being able to change consumer habits and move someone from drinking one Coke a day to moving them over to a brand like Buy, which is why we invested, right? We saw this evolution, to maybe potentially moving them to some type of flavored water like a Buy or something else, and then to maybe kombucha, to sparkling water. And if you can make those upgrades in your diet, and you just don't go from drinking Coke to eating kale overnight, right? It's got to be a natural progression so that behavior is sustainable and not just a quick diet crash. And so the long way of saying is that I think because we start off with an authenticity about trying to be better for you, it's allowed us to expand into other categories. And quite frankly, I think the pace of innovation, education, even from our standpoint, right, we're still learning every day. If you think about it, all these things, whether it's what you put in your body contributes to your health and wellness, what you put on your body, right? The toxins that may be in your shampoo or your soaps or your body washes, all the way to now understanding how sleep plays a role, right? In terms of wellness. Fitness obviously plays a role in your overall health and wellness. And then also you think about the mental part of it, right? With, the success with, Calm and Headspace and some of these other kind of mental platforms, your mental health is something that is now at the forefront that helps drive happiness and health and stronger, better for you living.
Sure.
And, I think we use the expression, the old Wayne Gretzky quote wrote, I don't skate to where the puck is, I skate to where the puck's going. And that is really kind of my North Star and CAVU's North Star in terms of how we like to invest. We will take a chance on something like collagen before, collagen was collagen, right? With the investment in Vital Proteins. When we invested in Vital Proteins in 2016, there wasn't a lot of education about collagen. Collagen has been around for ages, but really the health benefits of it were never really articulated, and it never was a mainstream product that the masses can have access to improve joint health or hair or nails or skin elasticity. And so you do take that kind of fad versus, risk. Is this something that can be a massive category? And you have to really play into that thesis to see if it's possible. It's
so interesting. You kind of teed up a question of mine perfectly there when you're talking about, skating to where the puck's going, not where it is, and the fad versus the way that I kind of was thinking about it is a category defining brand that is now a shift in consumer behavior versus a temporary fad. Of course, we know this is pretty rampant in the wellness and health industry more broadly. So realizing that is your North Star, just how do you even make some of those determinations? What are you evaluating when you're saying, okay, this is a flash in the pan, or like this is something we can get behind? Collagen, for example, essentially becoming the next whey protein, the next, in every drink, in every mix kind of supplement. How are you thinking about that and evaluating it when these opportunities come?
Yeah, that's a really great question. It's art versus science, right? And a lot of luck, right? Quite frankly. Take an example, kombucha. Kombucha was a category that we invested very early on in. And that name kombucha, 5-6 years ago was a little bit more scary than it was today. I still don't love that word kombucha. I think it doesn't really do it service. I think people don't fully understand kombucha on some fronts. But when we found a brand called Health-Ade, which is a brand of ours that we invested in very early on, what we saw was an alternative to soda that actually had the presence of good and not just the absence of bad. And what I mean by that was there is a functional benefit to drinking kombucha, right? Gut health and probiotics. And if you can offer the consumer something that has functionality, along with the presence, which is the presence of good, right? And the absence of bad, which is meaning, high sugary, high carbs, then I think that's a proposition that over time, what we looked at it is millennial soda, right? It's an alternative for millennial and Gen Z, and as we call them, Gen Zennials, to be able to not go for a sugary alternative, which carbonated soft drinks have been declining for years. Listen, I grew up drinking one a day. My children have never had a Coke or a Pepsi before. It's not that I won't let them. It's just, it hasn't been incorporated in their diet early on. And again, palates and food taste and sensitivity all develops when you're younger. And so, they'll be less attracted to sugary things because it hasn't been a part of their life growing up and their food, right? So you had one brand that was out there already in GT's Kombucha that was a pretty large company doing very well. That mitigated a little the risk, right? We weren't the category creator, but we were the fast follower. And I think in the way we look in investing, and specifically in food and beverage, you don't traditionally have a moat. Whereas in some other investments in tech, right, the speed of the product cycle is very fast and technology is ever changing. But, there is oftentimes a moat, which gives you a runway of, 18, 24 months, maybe a little less, maybe a little bit more, that actually has some technology that gives you a little moat so that you can kind of execute and be the category creator. We were a fast follower in health aid, but what ultimately did it for us was most kombuchas we had tasted before were too vinegary. And we found health aid was one that was approachable. The founder was incredible, and the founders, there's three of them. We thought it was a unique offering in terms of the glass bottle it was being positioned in and sold. And we just ultimately thought the taste was mainstreamable, where if kombucha became to grow as a category, we think this would be a natural selection for the consumer, given its taste profile over the existing kombuchas that were out there at the time.
Yeah. And thinking through some of those factors that, go into it, the fact that it is as much art as it is science, a little bit of luck mixed in there, sometimes more than others. In the health aid case, you mentioned the founders and the role that they played, and maybe even just for a little bit more context in the investment process overall, just like what stage you typically investing, how are you assessing those, the deals when you do come in, and then like, what is your involvement once you have invested?
Great question. So the difference between us and some other firms, and maybe we're smart for doing this, or maybe not, right? Time will tell, and time will be the arbiter in the results. But we actually have no preferred stage. We also don't have any preferred size of check. And I think that's a little unique and unusual. I think a lot of firms are very specialized and focused, where a brand needs to be at least a certain point in revenue, potentially profitable, not profitable, a certain stage, whether it's seed or Series A or maybe their later stage, right? And our premise for doing that was, when we talked to founders previously before founding CAVU, two things that stuck out to me which have been kind of our guiding principles as well, and our foundation of, so we always need to go back to kind of who we are as a culture and what we stand for. The first thing many founders told us before we started CAVU was, the minute we took money from venture or private equity, it got a little less fun. And we're very much are believers in, when we partner with a brand, we want to be partners. You got to understand, it is the most emotional. Someone's equity or the founder's equity, this is their baby, right? I am outside of family and friends. Like, this is the most important thing in their life, right? And it is a bumpy road as an entrepreneur. And so for us, the biggest advantage I think we have, and we always try to maintain, is that when the times are good, it's very easy to high five and say, awesome job, and celebrate. It's really when things don't go right, which is a lot of the time when you're starting a brand, right? You're going to have kickback, you're going to have setbacks, you're going to hit a landmine here and there. It's having a partner that is seen stuff like that before and doesn't get rattled when the first sign of turbulence comes. And that's really important. And making sure that you can stay more even keeled, and making sure the founder knows that even if a mistake was made, it's not the end of the world. Let's collectively take a deep breath, take a step back. And I think that is a really key element in terms of making sure it doesn't become unfun for them, and making sure that we can be there to be not only offer advice in terms of what they should do, but also be there as a support system from a mental standpoint and a confidence standpoint to make sure they keep going, right? And they're not discouraged at the first sign of trouble or if they hit a landmine. So that would be, kind of one thing. The other thing, and getting to the point here, is that a lot of firms, and sometimes, and rightfully so, they have minimum size checks. And the common feedback we got was that a lot of times you'll see firms, this is not all firms, but certain firms will want to write as much money into a brand as possible. And so they almost force the founder of the company to take on a little bit more capital than they need to. And there's nothing worse than overcapitalizing a business and forcing more capital onto a balance sheet that doesn't necessarily need it, right? Especially early on. I think brands that start off with less actually do better, because they have to make tough decisions and they have to kind of grind it out a little bit. They have to be very careful on, if they're investing in marketing, they can't choose every marketing, medium. They need to select one which they think is the highest ROI, right? And they can't just throw their money on every single one of those mediums. And so the long answer is, if we see an amazing brand or amazing idea or an amazing founder out there, we don't want to not be able to participate, because we have a minimum size check, which will prevent us from investing earlier on. Take Waterloo, for example. And so our check size will range from, we've written this check as small as a couple $100,000, up to $100 million. And so I think that large scale allows us to either lead a deal we can be passive on a deal, right? I think we play very well with other firms in a deal. And our motto is if there's other brands or partners or investors that can add value, why wouldn't we want them in the investor base, right? Because, if it means a little bit smaller piece of the pie for us, we're okay with that, because if they're value added, then it should be a much larger, outcome and pie at the end of the day, right? So we'd rather have a smaller piece of something larger.
Sure. It sounds like even getting those incentives aligned, helping those founders get to where they want to go, ultimately where you want to go as well, but doing it in a way where you're working together towards that, and maybe not on your agenda, the firm's agenda coming with that check. I think even, looking at the website, and it's something that has come up as we're talking about this conversation, this idea of brand. You talked about even in the origin story, like going to the store and looking at brands, thinking about brands. And now the companies that you work with, going to CAVU's website, it's like very design oriented, kind of like high energy. You can kind of feel it, and that focus on design and brand is forward there as well. Just what role does brand design, this idea of like finding unique and underpriced marketing channels, play in the companies that you're investing in? Because it looks like in all the portfolio companies, it's a key factor, and it also looks like something you guys are just excited about in general.
100%. So listen, we didn't make these rules, but people judge a book by a cover, right? And we've seen, I'll use a car analogy, right? You may have the best product in the world, so call that a Ferrari engine, but it has Ford packaging. And it's not a knock on Fords or anything, but it's just using that deep of analogy, right? And the problem is, because of the packaging may not be attractive or doesn't catch your eye, it may never drive trial. And what a shame, right? Having an amazing engine or product that never really gets its full advantage because people aren't drawn to it. Conversely, we've seen brands that have amazing packaging and beautiful, and it drives trial, and they may have that Ferrari packaging, it's reversed, and they may have a Ford engine. And so the real key is, if you find one of those, rare products that's amazing and has that Ferrari-like engine, you have to give it, Ferrari-like packaging, because that is going to drive trial. People judge, listen, it catches your eye on the shelf. If it's bold and bright and beautiful and catchy, you're gonna be like, oh, what's this? And you intercept the consumer. If you've got a great product and their experience is good, guess what? You've converted them, and now you have a consumer. Versus, not ever getting to test a great product because you're not attracted to the packaging, or you just kind of come into it by accident. We want to force those interactions a lot more if you have a great product. And by combining beautiful branding and packaging and activation along with a great product, really helps you intercept the customer, where then you have confidence that if you can drive trial, liquid to lips, so to speak, in beverages, you will have a consumer and help grow the brand. So it's extremely important. I think, we spend a significant amount of resources internally. We have an agency in-house called Uncommon, and Uncommon is really one of our, secret weapons. And the fact of, we've got really experienced professionals, and it's led by Stevie Clements, who, has been with CAVU since day one. We've assembled a great team of people who've had packaging design. So in-house, we can redo your packaging. One of our investments, a brand called One Bar, was a bar that we discovered out there. And it was in the packaging, and you can see the before and after, right? If you Google it, it was a brand doing very well, but really didn't have great packaging. We changed the name to One. And why we did that is we thought you can create a platform based off of 1 gram of sugar, 20 grams of protein, 1 gram of sugar, tastes amazing. And that was impactful. We did that whole packaging job internally. You look at Vital Proteins. We redid the packaging there internally. We did a huge out-of-home campaign with them in terms of Feed Your Beauty. We have a DTC Amazon specialist in-house. We have a social media influencer who helps build social media partnerships for micro and nano influencers in-house. So and that's going to keep expanding. We keep adding on pieces to the puzzle where when we go and meet with a company, that is definitely one of our edges and advantages in terms of, like I said earlier, trying to make the news and help change the trajectory of that journey. Listen, we're not talented enough necessarily to go start our own company, but finding an amazing founder and adding some rocket fuel to their story is kind of our mission.
Yeah, and that kind of answers a question that came to mind for me was, do you think of this as purely a value add? I mean, obviously, it's incredibly valuable to have this in-house, to be able to do this work, even if it helps them go from, 1 to 5 or 5 to 10 and get them out the door? Or do you think of it as like an in-house accelerator? You have all these different models now, whether it's an incubator, a venture studio, a product studio. Is it anything down that path, or just purely just like the ability to do it and do it faster?
Listen, we may evolve into more. I think now it's been primarily focused is finding a great brand, a great entrepreneur, and being able to provide whatever resources we can to help them potentially accelerate their journey, where they maybe get bigger faster. Again, we just don't want to spray and pray and just force growth for the sake of growth. It has to be quality growth. It has to be good customers and not just, buying sales. It's got to be organic growth. And so some of that marketing helps that. I think we will potentially evolve more into a studio like as well. I mean, we've co-founded brands before. So there's a brand in our fund too called Waterloo. So back in 2017, we were just amazed by the success of LaCroix. I couldn't understand it, quite frankly, right? And there's been a lot of sparkling water out there, private label for years, and it's not a new category. And so we decided that we thought there was room in the category for another brand, a branded sparkling water. So we came up with a brand called Waterloo, and had Austin roots, and the original name coming from Austin, right? And we formed that very quickly. We provided the seed capital. We went and helped get the team that ran Skinny Pop, which was very successful. We put Jason and his entire team into the company. This is pre-revenue. So we had an amazing team. We had well-funded capital, and we had a strategic partner in this brand that was helping accelerate the growth. And we set all that up very early on. And so the trajectory of Waterloo, right? It was an interesting one because we didn't have to spend a lot of money on traditional education. In collagen, no one knew what collagen was in 2016. We're now in 2021, and there's a greater knowledge and awareness of collagen, but there's still education to be had. And Vital Proteins is a massive company and success story, and they've done a really good job of educating the consumer. The lucky part for us in a brand like Waterloo was we didn't have to educate the consumer on what the product was. Sparkling water is very simple. The problem was it's ultra competitive. There's a lot of brands in the place that were private label. And so once we launched, we got really good traction. Then Pepsi launched Bubbly, which added another competitor. And then you've had a host of them. Coca-Cola came out with their AHA, which has a little bit different twist, right? It's more caffeine based. So it was one of those things where you had to kind of move quick and build a brand a little faster than you normally would. Because again, as you look at that set in a grocery store, they're only going to carry so many, brands within that set. You got to assume, LaCroix is going to have a spot in there given its massive growth and popularity. You got to assume that the grocer's private label version is going to be in there, right? And so then you have Bubbly. So we got in just in the nick of time where I think if we launched a sparkling water today, I think it would be very difficult to expand and grow fast. And, so we will co-found brands. We sold Waterloo at the end of last year. And so we have the ability to co-found companies. We will do it more. I think we did another one. My partner, Rohan Oza, is a guest shark on Shark Tank. He bid on a brand once called Mother. And Mother was, kind of a soda alternative. I would call it functional soda. And when he tasted the liquid, and Rose got a great palate for especially in beverage, he was wowed by it. But the packaging and the name weren't as great. And so we quickly invested in it was called Mother. We changed the name to Poppy. And we did the brand design in-house. So that was the Uncommon agency that did the brand design. They actually won an award. We funded it. We put in more of a team around the two founders, Steve and Allison. And now we're off to the races, right? So we have the ability to either go late, to go really early and start something, or somewhere in the middle.
Yeah, I think all of that makes a ton of sense, especially given your operational kind of expertise and ability to bring all the pieces together. And changing gears slightly, but I think it's related to that. Recently, you teamed up with Jason Karp to launch a $225 million SPAC focused on the health and wellness acquisitions. Can you just talk about, even at a high level, why is the right time to do that? And what do you hope to accomplish with, human co-acquisition?
Yeah, absolutely. Happy to share a little bit more background on how it came together. So obviously, Human Co., Jason Karp and Ross Berman, we've been talking to them for years about, what the art of possible is in terms of where the world's going and maybe doing something together in some way, whether it's starting a brand or investing in a brand together. Have a huge amount of success, right? Jason and Ross both came from the financial world, right? Hedge fund space. And then, Jason obviously co-founded Hue, just had an amazing exit to Mondelez. I think Mondelez got a great brand. And, I think having that authenticity again is Jason being a founder and having started a brand from scratch really that's invaluable experience and knowledge and know-how that is something that can be shared with others, right? And so obviously SPACs were the, last year and a half have been all the craze. Previously SPACs were a dirty 4-letter word, right? It didn't necessarily have the best reputation, right? It was almost for companies that should be public, but can't get public because there's some hair on them, right? Just to be, really direct. But that has changed. I think part of the reason that's changed is, I think obviously the traditional IPO market, right? And there's been a lot of talk about, the pricing discovery and IPOs, and then the first day lift and all the money that was potentially left on the table by the founders or the investors, et cetera. And so I think there is that argument out there of, well, that, that needs to be disrupted or changed a little bit. And I think obviously you've seen the rise of direct listings come, and you've seen companies like Spotify and I think Roblox now in the tech world, which my kids play every single day, is going to a direct listing. And so for SPACs, if you've noticed, they've become, it's overcrowded. I mean, there's hundreds and hundreds of SPACs. And originally, when we were looking at it in probably March or April of last year, we wanted to wait a little bit. We definitely were approached by some people and some banks about doing a SPAC on our own. We chose not to do it at the time. Again, sometimes being a pioneer is tough, right? And usually it's the fast followers that can kind of draft off that really have more success. And so we actually thought from a CAVU perspective that we want to wait to see how it played out a little bit, but the more importantly, we wanted the education to increase. And so sitting on the sidelines, and now with more and more SPACs becoming all the news and all the kind of rage, we really didn't have an interest in being the 1,000th and one SPAC to come to market. But when Jason called us, and they'd been approached obviously to do a SPAC as well, we really found common ground in terms of, you don't see two firms, and we compete, but we don't compete, right? I mean, I think what they're doing in Human Co is amazing. They're looking at, starting smaller and organically they're finding brands that are smaller or either starting their own, right? And creating a holding company. Where CAVU, we're kind of, more kind of, venture growth investors. And so the idea of putting two groups together that both have an enormous amount of value add, right? I mean, Ross and Jason with their financial expertise and being in the hedge fund space and looking at public companies and knowing how to value public companies and how to set the story so that when we do find a company, that we can position that company to be successful in the public market. Was all value add. And then plus you add on the experiences that they had with taking Hue from, nothing to now, a company that's been acquired by Mondelez in a very short period of time. And so those are invaluable. So we thought that power of value add and that operational expertise could be really interesting. And I think if you look at the SPACs now and what's happening, there is going to be the premium ones will rise to the top. And some of the ones that are just people that have access to capital and are very generalists and just want to go out and buy whatever, eventually it will weed out and the strong will survive. And I think in order to be strong and to survive, I think you've got to have a really focused, specialized area, right? You think about it. This is what we do every day, health and wellness. So we have extreme knowledge on the categories. We have extreme knowledge in terms of what brands are what and what they're doing and not doing and which ones are great, which ones aren't as good. Like we have institutional knowledge that I think gives us that, an advantage being specialized. And then you think about it, the fact of the matter is, if you were to go public the regular way, you're going to have, investors and, it's released in your 13F and they're probably not adding a lot of value, right? They're there as, institutional investors. But, we have the ability with a company that we find in a SPAC market, right, and merge with, to actually stay aboard and bring all of our value-added resources to help that company, once they're public, grow and become, even better. And I think if you look at health and wellness right now, I think the public markets were late in identifying kind of better for you, health and wellness, ESG, right? And I think and now they've caught on fully. And if you look at the performance and prior, and we talked about this in our roadshow, prior to Beyond Meat, and I really think that was a huge inflection point for our industry. You didn't see a ton of high growth consumer CPG companies going public. Previously you had Annie's that was run by John Forker, who's an amazing operator that went public and then got bought by General Mills. You've had Blue Buffalo, Fresh Pet, a handful, and most times the reception in the marketplace was phenomenal, right? They grew well and they were successful. Either they were bought, which Blue Buffalo and Annie's were, or they had they become very successful companies and have compounded significantly since they went public. But when Beyond Meat happened, that was an inflection point in my mind where, with the performance of that, and everyone talks about the performance of Beyond Meat, there is a lack of better for you health and wellness options in the marketplace for people to invest in. And so you look at some of these massive long only, mutual fund types that have an ESG component or a health and wellness consumer component to them. What can they invest in? What's available? And, from Beyond Meat, in the founder's mind now and CEOs of a lot of these companies in health and wellness, they never really thought that going public was a potential path to either taking growth capital or monetizing their hard work or their brand. It is now a part of either continued growth capital or exit considerations where they never really considered that before. And since you've had in the food and beverage industry, have Vital Farms, which went public and is trading at a very nice multiple. You had Laird Superfoods go public, again, with that kind of plant-based, traded at a very high multiple. You have a rumored Oatly IPO potentially coming, right? That there's been talk in the media about what that price could go out at and the reception for that. So there is, I think, now a window opening. I think, it's in the early innings. There's still not of assets available that can be bought from a health and wellness perspective. I mean, look at Peloton, right? I mean, look what Peloton's done. Obviously, COVID has greatly accelerated their business, but we think more and more are going to come. We think health and wellness is not a fad. You're not going to wake up one day, Joe, and say, you know what? That whole sugar thing being bad for you was fake news. Give me more sugar, right? So we're never going back. And so I think there is we're in the second inning of this wave of great health and wellness, ESG companies that are going to go public. And I think the public reception is going to be good for them because there's not a lot of assets they can own that are out there, and more will come over time. So we think there's a huge ability now where the public market is obviously paying a premium multiple versus the private market. And there's an arbitrage there. And so I think the ability to take a great company and merge with it and then bring our value add to it with a health and wellness approach is kind of our goal and our key. And we're excited about that.
Certainly no shortage of opportunities. And I think that's potentially a good place as we get to towards the end of the conversation. We've talked about companies you've invested in, companies kind of you've partnered with to co-found, helped accelerate. Now the potential to take some of these companies public via SPAC. Again, no shortage of opportunities. Thinking about the opportunities that do exist, the concepts and categories, what are areas that you're excited to, potentially write a check into or work with as this, evolution of health and fitness continues?
Yeah, 100%. I think I can't speak from a SPAC perspective, right? Because it's public, but I will say, let's look at it from the lens of CAVU, right? I think, as we talked about earlier, health and wellness now is, I think the same person that is waking up and drinking bulletproof coffee or is, careful about their diet or is a kombucha drinker or takes vital proteins, that consumer is also the same consumer that's probably using a Peloton or some digital fitness app, right? Or, going to a Barry's boot camp or whatever it might be. And that same person is also someone who's probably looking at things like even recovery, right? With Hyperice, and the same person is using Calm. So we think the consumer, and you think about the day of a consumer, right? We want to kind of intersect that consumer as many points as possible along that journey and path. And so health and wellness is expanded. From a CAVU perspective, again, I would be laughing at you if you told me 6 years ago we would be looking at mental health. I mean, it's critical, and it's crazy because people will go annually for a physical to make sure that your blood work is okay and that there's nothing that can affect your health going on with your body. But your mental health is arguably just as important as your physical health, right? There's nothing for that, right? We don't take care of our minds like we should. And so for CAVU, it is really anything health and wellness consumer based that we will look at. It could be digital fitness. It could be, things like a Peloton or a Tonal or Echelon. It's beauty, right? We've made our, we invested in Hims, which was kind of our first entrant into personal care. And that whole idea about telehealth, bringing, access to medicine and prescriptions a lot easier, right? That technology. And, we'll invest continually into more personal care and beauty brands, right? Beauty is a category in personal care that's behind food and beverage, right? So I think people have wakened up to what you eat and drink affects your health. I think people are now starting to realize as well, hey, what you put on your body, whether it's lotions or shampoos, they all potentially have toxins in them that affect your health. And so I think you're seeing more and more, even deodorant, right? I think, you see aluminum free and natural deodorants. Now, the hard part is I haven't found a natural deodorant that actually works, right? So that one's a little bit tougher, right? And there's been acquisitions in that space, right? So we're really looking at anything that has a health and wellness angle to it, that's consumer focused, where we can bring our kind of marketing and branding chops to kind of help accelerate that brand or that category.
Yeah, it's going to be incredible to watch. I'm excited about, the category, but also as you guys continue to expand kind of that purview, what you're investing in. Again, like you said, bringing those marketing and branding chops to the category. It'll be fun to watch. And with that, we'll actually get you out of here on this. If folks are interested in learning more and following along themselves, what's the best way to keep up with what you're working on at CAVU?
Best way is, we obviously update our website with new brands. We have our own Instagram, but I'm always widely accessible, or anyone at CAVU is. So I'm happy to, share my email with founders or anyone who has questions about getting in the industry. We're very big in terms of, a lot of people helped us get here and to where we are now. And we've only been around for 5 years, and, we still have a lot of work to do and wood to chop. But we always want to be accessible to others that are either getting started or need help. Again, it's hard to be everywhere to everyone, but we always want to be able to provide that guidance and counseling for people. So we're widely available.
Yeah, and I think this conversation today, I'm excited to share it. I think these insights and a lot of the things that you touched on will help do just that, continue to add value to the ecosystem. So super grateful that you took the time to join us, and really appreciate it. Excited to share the conversation.
Well, thank you for having me. And Joe, I said before, I'm very, very, what you guys put out in terms of content is great. And I look for new updates every day, and it helps challenge me in terms of thinking and questions that you pose, and stories that you do helps push our thinking, and we appreciate you for that. So congrats on all the success you've had.
Yeah, I appreciate it. We got to keep it going. So this will certainly contribute to it. Thanks again, Brett.
No problem. Thanks, Joe. Be well.
Thanks everyone for listening to today's episode. For more from Fit Insider, visit insider.fit.co and subscribe to our weekly newsletter for insights and analysis on the business of fitness and wellness. Then go ahead and subscribe, rate, and review the podcast. See you next time.